So this problem involves NPV, NPV or net present value. So in 19 does 3 requirement number 1. Net present value, estimate the annual cash flows for the new product. Now the controller of Science Company just received the following data associated with production of a new product. Expected annual revenues, projected product life cycle, equipment with salvage value of 100,000 after 5 years, expected increase in working capital, recoverable at the end of 5 years, annual cash operating expense of 450,000, and the required rate of return of 8%. So let's now compute for the annual cash flow for the new product. For year 0, you will involve a cash outflow equal to 900,000. That's for the cost of the new equipment and the working capital that will be needed to finance operations. So the total cash outflow as of year 0 is $900,000. Now, from years 1 to 4, it will involve an inflow, which is the difference between the expected annual revenue of 750,000 and the operating expense of 450,000. So the net cash inflow years 1 to 4 is 300,000. And as of year 5, the last year, still it will involve the same amounts of revenues and operating expenses. However, at the end of the life of the project, the fixed asset will involve a salvage value equal to 100,000. That's the salvage value. So at the end of the life of the project, it will become a cash inflow as you'll be selling the the asset. So you have an inflow of 100,000. And as stated, the working capital of 100,000 will be recoverable at the end of 5 years. So in other words, at the end of the life of the project, this working capital will be recovered. So your total cash inflow at the end of the 5-year period, you will now involve a net cash inflow of 500,000. So that's the net cash inflow of 500,000. Okay, so let's now involve requirement number 1. How much is the annual cash flow for the new product? Oh, we have now in year 0 an outflow of 900,000 outflow na. Yeah, years 1 to 4, we have inflows of 300,000. And as of year 5, again, we involve a net inflow equal to 500,000. So that gives us the total inflows if you are going to add the inflows from years 1 to 4 and from year 5. Now, in requirement number 2, using the estimated annual cash flows, calculate the NPV. So we have now the in requirement number 2, we have the NPV or the net present value. So year 0, we have the outflow of 900,000. That's why it's negative. The discount factor. By the way, class, remember, if you involve year 0 or sometimes it will state now or today, the discount factor, which is actually the present value factor, is 1. So today or now or 0, year zero, or that means at the beginning of the life of the project. So the present value now is taken by multiplying the cash outflow by the discount factor. Negative kay outflow. From years 1 to 4, as computed above, we will involve the net cash inflow of 300,000. And considering that that is for a period of 4 years, so from years 1 to 4, we now have a discount factor equal to 3.312. Now, that will be given, or that's found in your present value table. So 3.312, that's the present value of 1 in arrears for a period of 4 years. So present value of 1 in arrears for a period of 4 years. So the factor is 3.312, present value of 993,600. And finally, on year 5, the cash flow as computed above is 500,000, and the discount rate is 0.681. That's the present value of 1 at the end of the 5th year. You have only 1 year involved at the end of the 5th year, with a given discount rate. And the rate of return here is 8%. So, we now get the total of the present values. The total of the present values is NPV, or net present value, of 434,100. That's net of the cash outflows in requirement number 2. In requirement number 3, what if revenues were overestimated by $150,000? So, what if revenues were overestimated by $150,000? Redo the NPV analysis, correcting for this error. So, correcting for this error, assume the operating expenses remain the same. So, in requirement number 3, correcting for the overestimation error of 150,000 would cause the product to be rejected. Year 0, we have the outflow of 900,000 involving the same discount factor. Years 1 to 4, the cash flow is no longer the original amount of 750,000 given. However, it stated that the revenue is overstated by 150,000. So we now get your cash flow equal to here 600,000 minus 450. Nag 600,000 na lang because the original expected annual revenues of 750,000 minus the annual cash operating expense of 450,000. So that gives a difference of 300,000. And then we deduct expected increase in working capital, no? So repeat, expected annual revenue 750,000 minus the annual cash operating expense 450,000. So we have a difference of 300,000 minus the overestimation of 150,000. So we have the inflow remainder of 150,000 for years 1 to 4. And we still involve the present value of 1 in arrears for a period of 5 years, 3.312. So the present value of 496,800. And on year 5, again, we have only 350,000. That's 750,000 minus 400,000. Again, 300,000 minus the overestimate of 150,000. We only get 150,000. And then we add the salvage value and the recovery of working capital. That's why we have the cash flow of 350,000 and we multiply it by the discount factor. Now the discount factor is taken by multiplying 350,000. The discount factor is present value of 1 at the end of 5 years. So only 1 year is involved. So the net present value in requirement number 3 is negative. It's negative. In other words, you are not going to accept the investment proposal because it will give a negative NPV. Now we go to problem number 4. Problem number 4 is already about the IRR or internal rate of return. Now again, let's recall that we were able to discuss the two methods that consider the time value of money. One is the NPV, one is the NPV, and the other one is the internal rate of return. So the NPV, as we have already emphasized in problem number 3, and the IRR is now in problem number 4. So compute for the IRR in this problem. Excuse me. We go to problem number 4. Problem number 4 now is with the IRR. Okay, we have problem 19-4. That's using the IRR. The enterprises is considering two independent investments. A new automated materials handling system that costs 900,000 and will produce net cash inflows of 300,000 at the end of each year for the next 4 years. A computer-aided manufacturing system that costs 775,000 and will produce labor savings of 400,000 and 500,000 at the end of the first and second years. Cost of capital is 8%. Now, in number 1, calculate for the IRR for the first investment and determine if it is acceptable or not. Now, speaking of the IRR, that's the internal rate of return. It is acceptable if it is higher than the cost of capital. So, the cost of capital given the problem is 8%. Now, in the IRR, in the use of the IRR, first, we have to compute for the discount factor. And the discount factor is taken by dividing the cost of the investment by the annual cash inflows. So the cost of the investment is 900,000 and the annual net cash inflows of 300,000. So we get a discount factor that's equal to 3. Now that is the factor which you have to look for in the present value table. Now, since the life the investment is 4 years, in other words, in the table, you have the first column as N. N would mean the number of years of the investment. So, under N, you have to look for 4 years, no? I hope you're following. Under N, you have to look for 4 years, and you go sideward going to the right and look for 3.0. That is the factor. So I'll repeat, under the column N or number of years, you look for the factor, and the factor is 3.0. And going to the right, you look for the factor of 3.0. That is the factor. The interest rate corresponding to 3.0 is between 12 and 14%, which is the IRR. In other words, ang imo nga discount factor 3. Pangitaon mo ang 3 in line with N nga 4. So, pag pangita mo, going to the right, now you will find 3.0 as in between 12 and 14%, because above you have now your columnar headings which are in percentages. So it begins with 1%, 2, 3, 4, 5. So ang imo nga 3.0 is under, it's between 12 and 14%. That's your IRR. If you want to determine the most exact IRR, then you have to interpolate. But if the problem would just state what is IRR, so you can use approximately between 12 and 14%. Now, the IRR is greater than the cost of capital, which is 8%. Amo ng imo nga cost of capital. Since the IRR is higher than the cost of capital, the investment proposal is acceptable. Number 2, calculate the IRR of the second investment and comment on its acceptability. Use 12% as the first guess. So the second investment is the computer-aided manufacturing system, and the cost is 775,000 and will produce labor savings of 400,000 and 500,000 at the end of the first and second years. So first, we have to determine the IRR. We must find I by trial and error such that 775,000, the cost of the investment, is equal to 400,000 divided by 1 plus the interest rate, plus 500,000 divided by 1 times the interest rate squared. So we have now I equal to 12% as the first guess. Exhibit 19B1 yields discount factors of 0.893. So kung pangitaon mo sa year 1, pangitaon mo ang factor, no? 0.893, that's in line with year 1, and year 2, 0.797, and thus the present values for the two cash inflows. You multiply the present value factor by the amount of inflows. So, and you are going to add it to the amount of inflows during the second year. So you get 755,700. That will involve a lower interest rate as needed. So I is equal to 10%. We obtain 0.909 times 400,000 for year 1 and 500,000 for year 2. You now get 776,000, which is in between 755,000 and 776,600. Then we can say that IRR is between 10 to 12%. Since IRR is greater than the cost of capital is 8%, the investment is acceptable. But considering that we have the use of the discount factor. Requirement number 3, what if the cash flows for the first investment were 250,000 instead of 300,000? So, kung ang imong investment in requirement number 4 is just 250, tiya mo na ang imong number 3. You involve a factor that's 3.6 and you look for it, it's about 4%, which is less than the cost of capital, that's 8%. Now we have 19-5, 19-5 NPV versus the internal rate of return. So we have now the hospital is considering two differential low yield MRI system, the Clearbook and the Goodview systems. The proposed, the projected annual revenues, annual cost, capital outlays, and project life for each system are as follows. So we have now four, the Clearbook and the Goodview. So we have the total revenues and the annual operating expense, and we have the system involvement and the project life. So in requirement number 1, compute the NPV for the Clearbook system. So the NPV for the Clearbook system is taken by the following process: the inflow and the outflow. So the cash outflow at the beginning of the life of the project is 900,000. That's your system investment. And for years 1 to 5, you have now the annual revenues for the Clearbook, 720 minus 445. You have years 1 to 5 involving a cash flow of 275,000. And for the discount factor, again 0 or now or today is 1. And from present value ban annuity of 1 for 5% with an interest rate of 8% in arrears. So we now get the factor of 3.993. Now in the test, the factors will be given. Now, the annual revenue 720 and the operating cost of 445. So we have the net cash inflow of 275 with the discount factor. So the present value, as you can find, is 198,075. It's an inflow, no, to the extent that your NPV is positive. Higher ang present value of the inflows over the outflows. So 198,075, that's the NPV for the Clearbook system. Now, second, we have the NPA for the good view system. The NPV for the good view system is taken by the cost of the investment is 800,000 today and the factor is 1. Then for years 1 to 5, the annual revenue of 900 minus the amount of the annual revenue is 900 and the annual operating cost of 655. So we have the cash flow of 145, 245. That's your cash flow. So the discount factor, that's the present value of 1 in arrears at 8% for 5 years. So we now get 978, 285, the NPV of 178,285. That's now your NPV for the second project. The clear book system has the higher NPV and would be chosen. Now, in number 3, what if Keating Hospital wants to know why RRR is not being used for the investment analysis? Calculate the IRR, the calculate the IRR for its project and explain why it is not suitable for choosing among mutually exclusive projects. So in number 3, we have the clear book. The discount factor is here, the 3.273. In the IRR analysis, first we have to divide the initial investment by the annual cash flow. So for the clear book, the initial investment is 900,000 and 275,000 is the annual cash inflow. Ang cash flow gali is 200 uh, 45,000. That's project number 3. And the discount factor, okay, they are given. And we have now your present values. So for years 1 to 5, involving the IRR, no? So for sa number 2 mo, the clear book system has the higher NPV. Ang clear book system has a higher NPV as compared to the second project. Kaya ang imo second project, NPV is lower. Now, in the case of number 3, what if Keating wants to know why RRR is not being used for investment? We have to determine the IRR for each project, no? That's in requirement number 3. Okay, so in other words, we have to do similar computations in requirement number 3. Kaya balya, compute for uh, the IRR for each project. For each project. And explain why it's not suitable for choosing among mutually exclusive investments. So the discount factor for the clear book is 3.273. For the good view is 3.265. Now using the discount factor, we look for the IRR. So it's for the first project, it's 16%. Looking at the table, while the IRR for the second project is 16%. IRR is relative measure of profits, and when comparing two competing projects, it will not reveal the absolute dollar contributions of the projects and thus will not necessarily lead to choosing the project that maximizes wealth. The IRR is slightly better for the Goodview MRI system Yet the Clearview MRI system is clearly superior as it increases the value of the firm more than the other system. Now we go to number 6. We have the after cash flows. So the cash flow, we have the net income of 54,000 plus the non-cash expense. 480,000, that's the cost of the investment, and then we divide it by 4 years. So the annual depreciation is 120,000. Add it to the net income, you get the cash flow of 174,000. Then in requirement number 2, using the decomposition approach, calculate the after-tax cash flows for each item of the income statement and show that the total is the same as the income approach. So we now have the 1 minus the tax. So 1 for the revenue, we have to deduct the tax of 40%. We now get and then multiply it by 360,000. We get 216,000. That's already net of tax. Then for the cash expenses, again 1 minus 40% multiplied by 150,000. We now get 90,000. Now for the cash expense, 150. So net of tax, 90. And for depreciation, we just multiply 40% times 120,000. And that's only for depreciation. Why nakita nag-deduct sang 1, no? To the extent that depreciation is non-cash. So the operating cash flow is 174,000 in requirement number 2. What if it is desirable to express the decomposition approach in a spreadsheet format for the 4 years? Here in number 3, we have years 1 to 4. So 1 minus the tax rate times the revenue. So why you have 260,000, you have 360,000 revenue, and then we deduct the tax corresponding to the revenue is 40%. So you get 144,000 deduct from 360,000. So we get 144,000. And then 1 minus the tax for the expenses. So 150,000 minus 60,000, you get 90,000. Or you simply multiply 150,000 by 60%. And we have the non-cash expense and depreciation taken by simply multiplying the tax rate by the amount of the depreciation. So for the cash flows, for each year, we have 174,000. For the revenue, for cash operating expense, and for the non-cash operating expense. That's in requirement number 3. Then we have 7, independent with one another. Number 1, we compute for the payback period, 93,750. That's the cost of the tractor, and we divide by the annual cash flow. So it will require a period of 3 years. In number 2, the ARR, we have the net income figure of 108,000. That's the cash flow per year. However, we deduct the depreciation taken by dividing 360,000 by a period of 10 years. So you get 36,000 for the annual depreciation. So the difference divided by the cost of the investment of 360,000, the ARR is 20%. In number 3, we have now the payback period computed, and this time the cash flows are not uniform. So for years 1, and we have years 2 and 3, and year 1 42,000, year 2 58,000, then years 3 up to year 5 84,000, and even up to year 10. So the unrecovered investment for year 1, it's still 360,000, 336,000. We deduct the cash flow 42,000. So the unrecovered is 294. We deduct 58. It's still 235. That's for 1 year, 1 year. 235 minus 84. 151, 200 minus 84. You get 67, 200. So it's a period of 4 years, and the last year, year 5, you need to recover only 6,7,200, but you recovered 84,000. So dividing 6,7,200 by 84,000, that involves point 0.8 of a year. So your cash flow, the payback period is 4 years and 4.8 years. That's adding 1 to 4, and the last year, that's for year 5, that's only point 0.8. So we have now your average cash flows equal to 770 to 800. You divide it by 10 years. So you now get 77 to 80 per year. The total cash flows of 42,000, 58,000, and 8 times 84,000. That's how you got 770 to 800. And so your annual depreciation is also taken by dividing the cost of the asset by 10 years. And the